All right, welcome back. Now I want to talk about credit scores. A credit score is a measure of everybody's individual credit worth. Your credit score is a number that is calculated on information from your credit report. Lenders like banks, credit unions use this to figure out if they will lend you money based upon what your score is. They'll also determine what kind of an interest rate they will give you if they agree to give you the money in the first place. Most lenders use credit scores rather than credit reports because it's based on several different parts. Okay, here's credit scores. If your credit score is 750 above, it's excellent. 700 to 749 is good. 650 to 699 is fair. 600 to 649 is poor, and anything under 600 is bad. For any kind of good interest rate, you're going to have to be in that good or excellent credit scores. Now, Kaylee, with your Capital One card, your credit rating was in this fair department, and that is why you got the 20.15% interest rate. If your credit would have been good or excellent, you could have got that down into 3.9 to 2.9%. Okay, what is your credit score made of? There are several different things that your credit score is from. Your open credit card utilization, number of derogatory marks, total number of accounts, total hard credit inquiries, payment histories, amounts and distribution of current debts, age of accounts, and reason codes. Okay, let's first talk about open credit card utilization. This is calculated by taking the number of your open credit card accounts and dividing by the number of your open credit card limits. So as you can see here, this is just for credit cards. I just used some fictitious numbers here. This is how much is on the cards, 7 credit cards, what is owed on each card, and the limit. So you take the limit of how much, divide, and you get your percentage. So if you have a 10% utilization on your credit card, it's going to be in the good markings. So you want to keep your credit card utilizations down as small as you can to get into that excellent credit score. Okay, here are what goes into your credit card into your credit scores. Your number of derogatory marks. That means if any of your accounts are in collections, if you filed a bankruptcy, any foreclosures, or any liens. Now, your credit score is going to be severely affected if you have any of these. If you have a derogatory mark on your credit report, it can take 7 to 10 years to take off of your credit report. They can't be taken off early, and it influences whether people want to give you credit or not. It shows them if you have mismanaged money in the past. Total hard credit inquiries. Every time you go to get a car loan, a student loan, business loan, personal loan, credit card, or a mortgage, they go to the credit companies and request your credit report. The problem is this: if you have too many hard inquiries, they won't give you a loan because credit card companies or the home loan are going to think that you need cash. So they're not going to give you money. Your total number of accounts. That's another thing. There are 2 different kinds of accounts. There's a revolving credit, which is like a credit card. If you have a Victoria's Secret account, it could be $1,000 this month. It could be $500 next month. So it's going to go back and forth. Installments are more like a car loan, where you have loans that are due every single month for the same amount, house, car, all that. Most important thing about about your credit report is paying your bills on time. I cannot stress that enough. If you pay these bills on time, your credit report is going to go up, and you're going to have a much better score. Okay, the last thing I wanted to show you today was a mortgage. Let's say that you financed your house for $100,000. What I was just telling you about was credit report. If you have a good credit report, you're going to get that $100,000 loan for 2% interest. That is going to be your house payment right here. If you have bad credit and it goes from 2 to 6%, look at the increase. That's a $200 a month increase because your credit is bad. Now, if you have to go down to the 10% because your credit is horrible, you're almost doubling what your credit could be if you had a good credit report. Here was the same thing we went with Kyle's. That $100,000 that you got for that loan, on a 15-year mortgage, you're going to pay 180 payments, $752 a month. You're going to pay $100,000. But since you have a good interest rate, you're only going to pay $35,000 in interest. So at the end of your $100,000 loan in 15 years, making the minimum monthly payment every month, you'll end up paying $135,000 for that house. But like I said, you always want to pay more than you can because you want this interest down. As you can tell, when the first year, you're paying the same in principal as you are in interest. By the time you get down to your 15 year, you're paying $800 or $500 a month in principal and only $200 a month in interest. Okay, so today we have talked about how to get student loans. We've gone through all three of you guys' financial difficulties. We've seen different ways to pay off your bills. We decided that Corey's going to try and put a little bit more money on her student loans every month. Kaylee is going to continue to make her $100 a month payments and add money when she can. And Kyle is going to continue to make his $105 a month payments, and if he would like, pay more towards the interest. We talk about the difference between a high credit score and a low credit score and how it gives you good loans or whether it gives you bad loans. And we talked about mortgage loans. I hope you've all learned something from this class. Does anybody have any questions? No? Okay, well, I thank you for attending this class of financial documentation, and let me know if you have anything else in the future. Good night.